We've got some major breaking news shaking up the markets today. If you've been watching your portfolio, you've probably noticed a sea of red. U.S. stocks took a nosedive, and it all comes down to the latest signals from the Federal Reserve. The big headline is this: the Fed just poured some cold water on hopes for quick and easy interest rate cuts, and the market is not happy about it. So, what exactly happened? The Fed has been signaling a very cautious outlook, basically telling Wall Street to pump the brakes on its excitement. For months, the market was pricing in a series of rate cuts, starting sooner rather than later. This was the fuel behind a lot of the optimism we saw at the end of last year. But now, that narrative is being seriously challenged. The Fed's latest statement suggests they're in no rush to slash rates, and this hesitation has sent shockwaves through the financial system. The core of the issue is inflation. We just got some new inflation readings, and they were hotter than anyone expected. Instead of continuing its cool down, inflation ticked up unexpectedly. This is a huge red flag for the Fed. Their number one job is to get inflation back down to their 2% target. And these recent numbers show the fight isn't over yet. When inflation is sticky or even rising, the last thing the central bank wants to do is cut rates, which could pour more fuel on the fire and make prices climb even higher. This has put the Fed in a really tough spot. On one hand, they don't want to keep rates too high for too long and risk tipping the economy into a recession. But on the other hand, they can't afford to declare victory over inflation prematurely. This balancing act is creating a ton of ambiguity. The Fed's language has become very non-committal, filled with phrases like data-dependent and we'll see. For investors who crave certainty, this kind of vague guidance is terrifying. And it's a major reason why investor confidence is starting to wane. The market hates uncertainty more than anything else. Let's look at how this is playing out in real time. The major indices, the Dow Jones, the S&P 500, and the NASDAQ, all saw sharp declines right after the Fed's outlook was digested. Tech stocks, which are particularly sensitive to interest rate expectations, were hit especially hard. When the cost of borrowing money is expected to stay higher for longer, it eats into the future profit margins of these growth-oriented companies, making their stocks less attractive. Another key indicator to watch is the bond market. Treasury yields, specifically on the 10-year Treasury note, have been climbing. This is a classic sign of economic concern. When investors are worried about the future, they demand a higher return for lending their money to the government. Rising yields also have a ripple effect across the economy, making everything from mortgages to car loans more expensive for the average person. It's a clear signal that the bond market is bracing for a tougher economic environment ahead. What's really creating this whirlwind of volatility is the massive disconnect between what the market wanted and what the Fed is delivering. Wall Street had already priced in a perfect landing. Inflation would come down smoothly, and the Fed would reward everyone with a series of rate cuts, sending stock prices to the moon. But reality is proving to be much messier. The Fed's hesitation is a direct contradiction to those rosy expectations, and when expectations and reality collide, you get the kind of sharp, volatile market reaction we're seeing right now. And to complicate things even further, the labor market data is sending mixed signals. On one side, we're seeing strong job creation numbers, which is great for workers and suggests the economy is robust. But a hot labor market can also contribute to wage inflation, which is another thing that keeps the Fed up at night. If people are earning more, they're spending more, and that can keep upward pressure on prices. So even good news on the jobs front is being interpreted with a sense of caution, adding another layer of instability to the market. So where do we go from here? The short answer is nobody knows for sure, and that's the problem. We are in a period of heightened uncertainty. Every new piece of data, whether it's an inflation report, a jobs number, or a retail sales figure, is going to be scrutinized with incredible intensity. Investors and analysts will be hanging on every word from Fed officials, trying to decipher any hint about their next move. This means we should all be prepared for more volatility in the coming weeks and months. The market is going to be jumpy, reacting strongly to any new information. For long-term investors, the key is not to panic. Market downturns are a normal part of the investing cycle. It's important to have a solid plan and stick to it, rather than making emotional decisions based on one day's headlines. It might be a good time to review your portfolio, make sure it's diversified, and align with your long-term goals and risk tolerance. For traders, this environment could present opportunities, but it also comes with significant risk. The swings can be dramatic in both directions. The days of easy money in a market that only goes up are on hold for now. Navigating this new landscape will require a lot more skill, a lot more research, and a very steady hand. In summary, the market is throwing a tantrum because the rate cut party it was expecting has been postponed indefinitely. The Fed is standing firm, spooked by persistent inflation, and this clash has sent stocks tumbling and bond yields soaring. With mixed signals from the economy and a Fed that's playing its cards very close to its chest, uncertainty is the new name of the game. We're in for a bumpy ride, so buckle up. So let's set the scene. Everyone was waiting on the edge of their seats for the latest announcement from the Fed. For months, the big question has been, when will the Fed start cutting interest rates? High rates have been the primary tool to fight inflation, but they also put the brakes on economic growth and can be a real headwind for the stock market. The market had been pricing in the possibility of rate cuts happening sooner rather than later, which has been a big reason for the recent rally we've seen. But then the Fed dropped its latest statement, and the tone was, well, let's just say it was less certain than many had hoped. Instead of giving a clear signal that rate cuts are just around the corner, the Fed basically said, hold your horses. They acknowledged that inflation has been cooling down, which is great news, but they also emphasized that they need to see more consistent evidence before they feel comfortable easing up on their policy. They used words like cautious and data dependent, which in Fed speak means they're not committing to anything just yet. How did the market react? Instantly. We saw the major indices, like the S&P 500 and the NASDAQ, take a sharp downturn. The initial optimism that had been building up all week evaporated in minutes. Why the sudden panic? Well, Wall Street hates uncertainty more than anything. When the path forward isn't clear, investors tend to sell first and ask questions later. The dream of cheap money flowing back into the system got pushed a little further into the future, and that reality check hit the market hard. Tech stocks, which are particularly sensitive to interest rate expectations, were hit especially hard. Now, let's unpack what the Fed is actually looking at. There are two main things on their dashboard: inflation and the job market. On the inflation front, things have improved. We're not seeing those eye-watering price hikes we saw a year ago, but the Fed is worried about sticky inflation, a situation where prices for certain services remain stubbornly high. They don't want to cut rates too early, only to see inflation come roaring back. That would be a policy nightmare. On the other hand, the job market has remained surprisingly strong. A strong job market is good for workers, but for the Fed, it can signal that the economy is still running a bit too hot, which could contribute to inflationary pressures. It's a delicate balancing act. So, what does this mean for you, the average investor, or just someone trying to understand where the economy is headed? First, don't panic. Short-term market volatility is normal, especially around Fed announcements. A single day's drop, even a sharp one, is not necessarily a sign of a long-term trend. This reaction is based on shifting expectations. What the Fed's new stance does suggest, however, is that we might be in for a period of higher for longer interest rates. This could mean that borrowing costs for things like mortgages, car loans, and credit cards might stay elevated for a while. For your investment portfolio, this is a good time to review your strategy. If you're a long-term investor, these kinds of pullbacks can actually be buying opportunities. Think about it. Quality companies are now on sale. However, it also highlights the importance of diversification. The sectors that thrive in a high-rate environment, like financials or some value stocks, might perform differently than the growth-oriented tech stocks that have led the market for so long. It's not about timing the market perfectly, but about being prepared for different economic scenarios. Now, let's look beyond the US. This isn't just an American story. The Federal Reserve is the world's most influential central bank. When the Fed makes a move, the whole world feels it. A strong dollar, which is often a result of high US interest rates, can create challenges for other countries, especially emerging markets that have debt denominated in dollars. International companies that do a lot of business in the US are also watching closely. So this signal of uncertainty from the Fed creates a ripple effect across the entire global financial system. Central banks from Europe to Asia are now reevaluating their own policy timelines based on what the Fed just did, or rather, what it didn't do. So, where do we go from here? The market is now recalibrating its expectations. The focus will shift intensely to the next batch of economic data. Every inflation report, every jobs number, every retail sales figure will be scrutinized for clues about what the Fed might do next. We're entering a phase where the market will be highly sensitive to economic news. It's going to be a show me the data environment. This means we can probably expect more volatility in the coming weeks and months. The smooth ride up we saw at the end of last year might be replaced by a choppier, more sideways market until we get more clarity. For those of you thinking about the bigger picture, this is a pivotal moment. We are at a potential inflection point for the global economy. Are we heading for a soft landing, where inflation is tamed without causing a major recession? Or does this extended period of high rates risk tipping the economy over the edge? That is the billion-dollar question that everyone is trying to answer. The Fed is trying to navigate this narrow path, and their latest announcement shows just how carefully they are treading. So, to sum it all up, the Fed has signaled it's not in a rush to cut interest rates, injecting a dose of uncertainty that spooked the stock market. This means we should prepare for continued volatility and potentially higher interest rates for a bit longer. For long-term investors, this is a time for patience and strategy, not panic. Keep an eye on the economic data, because that's what will be driving the narrative from here on out. It's a fascinating, if nerve-wracking time to be watching the markets. What a day on Wall Street. If you've been watching the markets, you know exactly what I'm talking about. We just saw some major moves that have left a lot of people scratching their heads. The Dow, the S&P 500, the NASDAQ, they all took a pretty significant tumble today, and it all comes down to a few key words from the Federal Reserve. So, what exactly happened? Earlier today, the Fed released its latest statements, and while they didn't announce a surprise rate hike or anything that drastic, the language they used was enough to send a ripple of uncertainty through the entire market. They signaled that the path forward for the economy is, and I quote, highly uncertain. Now, to you and me, that might sound like common sense, but in the world of high-stakes finance, uncertainty is the enemy. Investors were really hoping for a clear signal, a sign that the Fed has a firm grip on inflation and a solid plan for what comes next. Instead, what they got was a dose of ambiguity. The Fed basically said, we're watching the data and will act as needed. This leaves the door wide open for future rate hikes, and it dashes the hopes that we might see rate cuts anytime soon. The market hates ambiguity. It thrives on predictability. When that's taken away, you see the kind of sell-off we witnessed today. Let's break down the reaction. Tech stocks, which are particularly sensitive to interest rate expectations, were hit hard. Companies that rely on borrowing for growth suddenly look a lot less attractive when the cost of that borrowing could go up. We saw major names in the tech sector slide, pulling the NASDAQ down with them. It wasn't just tech, though. Financials, consumer discretionary stocks, basically any sector that's sensitive to economic health felt the pressure. Why is this happening now? Well, the economic data has been a mixed bag lately. On one hand, inflation has been cooling off from its peak, which is great news. But on the other hand, the job market remains surprisingly strong, and consumer spending is holding up. This resilience is a double-edged sword. It's good for the economy in the short term, but it also gives the Fed a reason to believe they can keep rates higher for longer to make absolutely sure inflation is stamped out for good. They're worried about what they call a second wave of inflation, and they're willing to keep policy tight to prevent that from happening. Today's market movement wasn't just about what the Fed said, it was about what they didn't say. There was no victory lap on inflation. There was no hint that the tough medicine of rate hikes is about to end. For months, the market has been pricing in a soft landing scenario where the Fed perfectly navigates the economy back to stable prices without causing a major recession. Today's statement has thrown some cold water on that optimistic outlook. So, is this a market meltdown? I'd say that's a bit of an overstatement for now. A meltdown implies panic and a complete loss of confidence. What we saw today was more of a repricing of risk, a reality check. Investors are adjusting their expectations. The dream of a quick pivot to lower rates is fading, and the reality of a higher for longer interest rate environment is setting in. What does this mean for the average investor? First and foremost, don't panic. Volatility is a normal part of investing. Days like today are gut-wrenching, but making rash decisions based on one day's news is almost always a mistake. It's a good time to review your portfolio and your long-term strategy. Are you diversified? Is your asset allocation in line with your risk tolerance and your financial goals? These are the questions to be asking, rather than, should I sell everything? Looking ahead, all eyes will be on the upcoming economic data. Every inflation report, every jobs number, every retail sales figure will be scrutinized for clues about what the Fed might do next. The market will likely remain choppy as this uncertainty plays out. We're in a data-dependent mode, and that means we could see more swings in both directions. It's also important to remember the bigger picture. The stock market is a forward-looking mechanism. It's trying to predict where the economy will be 6 to 12 months from now. Today, it predicted a tougher road ahead. But predictions can change. If we start to see clear and consistent data showing inflation is truly defeated without crushing the economy, sentiment could shift just as quickly in the other direction. For now, the narrative has shifted. The easy gains we saw earlier in the year were fueled by optimism. Now, a dose of realism has taken hold. The path forward for the U.S. economy and the stock market is less certain than it was just 24 hours ago. This isn't a signal to run for the hills, but it is a wake-up call. It's a reminder that the fight against inflation isn't over, and the Fed is going to remain vigilant. Prepare for more volatility in the coming weeks and months. The market will be hanging on every word from Fed officials and every new piece of economic data. It's a time for patience and a steady hand. We'll be here to track it all and help you make sense of it. That's the latest on the markets for today. It was certainly a roller coaster, and the ride might not be over yet. Thanks so much for tuning in. If you found this breakdown helpful, be sure to hit that like button and subscribe for more updates. We'll keep you posted on everything you need to know. See you next time.